There is tremendous momentum in gold and silver prices at the moment. Prices have surged sharply over a relatively short period, creating a sense of awe as well as anxiety among investors. New investors in particular are fearful of entering the gold and silver markets at this stage because the rally has been unprecedented and extremely steep. Many of them worry that they may be buying at the peak and that any correction could result in immediate losses. Yet, at the same time, fear often gives way to greed when these investors hear bold forecasts from reputed market analysts, such as Robert Kiyosaki, who has publicly stated that gold prices could rise to extraordinary levels in the future. According to such projections, gold prices could potentially touch levels equivalent to around 8 lakh Indian rupees, which further fuels speculative interest and emotional decision-making among investors. In a recent post on social media platform X, earlier known as Twitter, Robert Kiyosaki predicted that the price of gold could rise to as high as $27,000 per ounce. When this projection is viewed from an Indian perspective, it implies that 1 ounce of gold could be worth well over 8 lakh Indian rupees, translating into extremely elevated prices per 10 grams. Such numbers naturally capture public attention and generate widespread discussion, excitement, and debate across financial markets and social media platforms. Now, let us try to understand why this prediction by Robert Kiyosaki could potentially turn into a reality, or at least why a large section of the market believes that gold still has significant upside potential. There are 3 major reasons behind this prediction of a sharp rise in gold prices. First, tariff threats by Donald Trump have created widespread uncertainty and instability in global economic affairs and international trade. Protectionist policies, repeated tariff announcements, and sudden shifts in trade strategy have disrupted global supply chains, increased costs for manufacturers, and reduced visibility for long-term business planning. This persistent uncertainty has shaken investor confidence across equity and bond markets worldwide. As a result, financial markets have become highly volatile, prompting investors to move away from risk assets and look for safer and more stable avenues to preserve their capital. Second, there has been heavy and sustained purchasing of gold by central banks across the world. This trend reflects a growing concern about the long-term reliability of the US dollar as the dominant global reserve currency. Rising fiscal deficits, expanding government debt, and geopolitical weaponization of currencies have led many countries to rethink their reserve strategies. Consequently, central banks are increasingly diversifying their reserves away from the dollar and reallocating a larger share toward gold. Alongside this, expectations of interest rate cuts by the Federal Reserve have further strengthened gold's appeal. Lower interest rates increase liquidity in the financial system and reduce the opportunity cost of holding non-yielding assets such as gold. With more liquidity available, a significant portion of capital naturally flows into gold and silver. Third, and most importantly, escalating geopolitical tensions across different parts of the world are playing a critical role in driving gold prices higher. Incidents in Venezuela, along with heightened tensions between America and Iran, have raised concerns about regional instability, energy supply disruptions, and the possibility of broader geopolitical conflicts. Wars, military confrontations, and diplomatic breakdowns increase uncertainty about global growth and financial stability. In such an environment, investors typically reduce exposure to equities and bonds and increase allocations to safe haven assets. The combined effect of these factors is that investors are increasingly abandoning stocks and bonds and turning towards gold as a store of value. As is widely known, gold is considered a classic safe haven asset. During periods of uncertainty, geopolitical tensions, and the risk of wars, gold and silver prices have historically tended to rise sharply. In such conditions, investment demand for gold strengthens significantly, reinforcing the upward momentum in prices. This clearly indicates that, at the global level as well, investors are increasingly viewing gold and silver as reliable safe havens in uncertain times. This brings us back to the statement by Robert Kiyosaki, which has drawn widespread attention and intensified speculative sentiment. On the one hand, high prices of gold and silver have certainly impacted jewelry demand, especially in price-sensitive markets like India. However, from an investment perspective, demand for gold, ETFs, coins, and small bars continues to rise steadily, indicating strong investment-led demand rather than consumption-driven demand. The biggest question now is, what should investors do at this stage? Market experts generally believe that unless there is a sharp reversal in global conditions or a significant rise in interest rates, the chances of a major fall in gold prices remain limited. Even if minor corrections occur, many investors are likely to view them as buying opportunities rather than exit signals. However, this mindset has also created a dangerous perception. Increasingly, people are beginning to view gold not as insurance against uncertainty, but as a get-rich-quick instrument. This speculative behavior has contributed to the parabolic rise in gold and silver prices and has pushed these assets into what appears to be bubble territory. History shows that whenever such bubbles burst, it is small and retail investors who suffer the most severe losses. Therefore, while gold and silver may continue to remain strong, investors must prioritize caution over optimism. Any investment decision at this stage should be driven by risk management and long-term financial planning, rather than fear of missing out or exaggerated price projections. As prices of gold and silver has already risen manyfold in last few months, and a sharp correction in prices can happen anytime now. Further, leverage trading must also be avoided at any cost, as of late, gold and silver prices have become highly volatile, and volatility, particularly intra-day volatility, can result in sharp losses, particularly in leverage trading positions. In addition to global factors, government policies also play a crucial role in influencing gold and silver prices, especially in countries like India, where a significant portion of demand depends on imports. Changes in import duties on gold and silver, whether increases or reductions, can have an immediate and visible impact on domestic prices. Similarly, provisions announced in the Union Budget, such as alterations in customs duties, tax treatment of gold-related investments, or regulations affecting gold ETFs and sovereign gold bonds, can influence both investor sentiment and physical demand. Even outside the budget, policy decisions, regulatory adjustments, or administrative measures taken by the government can affect supply dynamics and price discovery in the domestic market. Therefore, gold and silver prices are not driven solely by global trends, but are also meaningfully shaped by domestic policy decisions and fiscal measures. Another important factor influencing gold and silver prices, particularly in India, is the value of the Indian rupee vis-a-vis the US dollar. Since gold is globally priced in dollars, any movement in the dollar-rupee exchange rate has a direct impact on domestic gold prices. When the dollar strengthens or the Indian rupee weakens, the cost of importing gold rises, leading to higher gold and silver prices in rupee terms, even if global dollar prices remain unchanged. Conversely, if the rupee strengthens against the dollar, which is relatively rare and usually short-lived, imported gold becomes cheaper, exerting downward pressure on domestic gold prices. This inverse relationship means that currency depreciation amplifies gold price rises in India, while currency appreciation can partially offset global price increases. Therefore, fluctuations in the INR to USD exchange rate act as a powerful transmission mechanism through which global gold prices are reflected in the Indian market. Investors must take their decision on whether to invest in gold and silver only after carefully considering all these factors.